Hi there. Let's talk about the dark side of MMFs that nobody talks about. Money market fund. When you say the term MMF in Kenya, most people assume it is free money, money which they're going to get a reward for investing. Yet the reality is very far off. That's why today I want us to have an honest conversation, not to discourage you from investing in money market funds, but to help you avoid expensive mistakes. Because many Kenyans, they think MMFs are magic. The word MMF is out there on the street. The reality is that MMFs are not magic. By the end of this video, you'll understand the biggest risks, hidden truths, and limitations when it comes to investing in MMFs. You are all much welcomed. My name is Afagza Sifuna. In case you are new here, remember to subscribe and also drop a like on this video. Thanks for joining the family. MMFs are basically monies which are pooled from thousands of investors, and then fund managers invest the money in relatively low risk investments to be able to possibly make a return or gain something. Talk about treasury bills, commercial papers, short-term government securities, and other short-term investments. The profits earned are then shared among investors after deducting management expenses. In Kenya, many people start investing with as little as, for example, 100 shillings, 1,000 shillings, you name it. The money also earns interest each and every day. This is why MMFs have become extremely popular in Kenya. But popularity doesn't mean they are perfect. Let's discuss what nobody tells you. The first truth is that MMFs are not guaranteed. Look here. This might surprise many people. People think my money is guaranteed. Once I put in MMFs, my money is fully guaranteed. That's not exactly the case. MMFs are investments. They are not bank savings account. Unlike money held in a bank, which you have limited protection under the Kenya Deposit Insurance Scheme, MMFs do not guarantee you'll never lose your money. Their investments inside the fund can fluctuate. Now, the chances of major losses are generally low because MMFs invest in short-term, high-quality securities. But low risk does not mean no risk. There's always an investment risk. That's why you should choose reputable fund managers with strong track record, not just jumping to any quack out there. You lose your money. Then the second truth is that returns keep changing. Many advertisements show attractive returns, maybe 10%, 12%, 13%, you name it. What most potential investors don't know is that these rates are not guaranteed. Some investors assume I'll earn this particular percentage forever. Unfortunately, that is not the case. That is not how MMFs work. Returns change constantly depending on several factors out there. For example, treasury bill rates, okay? For example, interest rates. For example, inflation. For example, market conditions. All these play a part in changing dynamics that's impacting the rates which you're gonna get a return in case you invest. Suppose you invest, for example, 500,000 Kenya shilling. If the fund earns 12% annually, that's approximately 60K, okay? But if rates, for example, fall to 8%, your annual earnings will be reduced to about 40K. Same investment, different returns, even though some of these funds will advertise a given return percentage while trying to source investors, okay? And then the truth number 3 is that inflation can still beat your returns. This is probably the biggest hidden danger. Imagine your MMF, for example, earns 9%. Sounds very good, okay? But what if inflation exceeds 9%? For example, it hits 10%. Your purchasing power has actually reduced. Your account balance may have increased, but your money will still buy less. Because if the return is lower than the inflation, then your purchasing power in net will still have reduced because the essentials, think about fuel, rent, school fee, money for food, medical costs, all those are going to move in tandem with inflation to compensate for the effects of inflation. If your investment, and unfortunately, in case you put all your investment in one bucket, which is MMF, is not returning a rate which is higher than inflation, chances are you will be in the red zone when it comes to you improving your purchasing power. Truth number 4 is that MMFs won't make you rich. I know this is controversial. Money market funds are excellent at preserving capital. They are excellent for emergency funds. They are excellent for short-term goals. But they are not designed to make you wealthy. That is what it is, okay? They are not designed to make you wealthy. And let's compare some numbers here. Suppose someone invests 1 million in MMF earning 10%, okay? They may earn roughly 100,000 annually before applicable fees and taxes. That is good money. Now compare that with someone who builds successful business. Okay? The person who has built a business has better upside compared to the person who has put money in the MMF in case that particular business takes off. Invest consistently in broad equity markets over years. Maybe that will give you a higher return. Or purchase real estate which appreciates faster, might give you higher returns. Or put your money in more investments which have a higher upside. Like for example, deposit your money or put your money in dividend paying stocks. And then the fifth truth is that, yes, fees are going to eat into your investment more than you think. Most people assume I put my money in MMF, if they say it's 12%, I'm going to get 12%. No, you have management fees, you have trustees fees, you have custodian fees, other operating expenses. Most investors only look at the advertised return and assume that return is going to be their entire money to take home. A fund earning 11% with higher costs may leave you with less than that particular amount of money or that particular percentage, or even almost half of it, in case they are committing their costs to that particular earning. And then the sixth reality is liquidity is good, but not instant. Many advertisements out there say, for example, withdraw money instantly, get your money instantly. But the general rule is that that is not always the case. You know, it doesn't mean once you need your money, you're going to get your money immediately. Some withdrawal take, for example, 1 or even a few more business days for you to be able to get your money because of maybe approvals, banking systems, you name it. So in case you have your money in MMFs because you assume if you need the money at this particular point in time, you snap, you get your money in 1 hour. Unfortunately, that is not the case because there's processes for you to be able to access the money, even though you might access them maybe in a day or even a few business days. And then truth number 7 is that not all MMFs are equal. That is a mistake many beginners make. They assume all MMFs are the same. They assume all MMFs have the same payment mechanism. They assume all operate the same way. That's not true. Different fund managers have, first and foremost, different investment strategies. They have different costs. They have different customer service structures. They have different withdrawal experiences, different historical performances. There is a ton of differences and preferences across different fund managers. So take time to compare, take time to study to understand what each MMF or fund manager out there is bringing to the table before you make a decision as to whether to go with a given MMF or not in case you want to put your money in MMF. So, with all that said, should we invest in MMF or not? The key is to look at all these dynamics first. Who needs to invest under what context? Case in point, if it's money for emergency fund, put it there, fair enough. You know, if it's saving for school fees, that's a good credit for you to be able to save. If it's saving for holiday, that is amazing. If it's holding money while waiting for another investment opportunity, MMF is amazing. You know, if you are a new investor learning how investment works, MMF could be a good entrance point for you. But you should also not put your money there in MMF as a forever investment, as your wealth growth is going to be curtailed, and yet there might be better alternatives, quality alternatives out there, you know. And also, don't put all your money in MMFs because it is important for you to diversify your investment portfolio. That's a key thing. Diversify and think about applying back your investment across the portfolio. As I conclude, MMFs are not bad. They are good. Credit for you to invest or put your money there, to hold your money there while you are thinking about other better alternatives. Utilize them. Utilize them in a safe way. Utilize them for liquidity buffer. Utilize them for emergency saving. But then again, also be open to other options which have better returns and they are better at also assisting you build your portfolio. Guys, What do you think about this video? Have you invested in MMF? If you have you put all your money in MMF or have you diversified your portfolio? And also, what is your experience with different fund managers in Kenya? Are all the fund managers the same? Are there some which you really say are best compared to others? How has your experience been investing in MMFs? In case you're new to this, I hope this video is exciting to you, and new and also existing investors are going to capitalize and utilize this knowledge for them to be able to see if any of this knowledge is useful and they can factor in their investment. Please note, I'm sharing this from my point of view. This isn't financial advice. Do your own research before you make any financial investment decision. That is on you. The risk taking is on you. I'm just here sharing knowledge, which I think is important for people to know and probably think if it's useful to them. Cheers, guys. I look forward to share with you other amazing videos next time. Take care.